Okay, welcome to Commodity Exchange, everybody. My name is Mark Haraburda, and I am the CEO of Barchart. This event that we have scheduled today is rescheduled from our event that was to take place this past May in Chicago, and unfortunately, that did not take place. But we're really excited to put together a virtual style event, and we think the timing for this discussion on the grain markets is pretty good. It's great to see all of our panelists, who I'll introduce in a few minutes. It's great to connect with them, and from Barchart's perspective, we are deeply involved and integrated in the grain markets, as well as with agribusinesses through data and technology solutions. We're really excited to host events like this. We've been hosting a series of webinars over the past few months as well, where we discuss some of our new products and share some of our new data, like our yield forecasts. And those have gone over very well. We're thrilled to host this event and to pull together the participants that we have this week. So on the screen, you'll see all of our panelists, and then you should also see a presentation right now showing the schedule events. And we kept this relatively simple, with one panel a day. With some good topics, grain market perspectives. We have a variety of individuals today to talk about their perspectives. Tomorrow we're going to be talking about ethanol, and then on Wednesday we're going to be talking about innovative ag tech, new developments in the ag data and software area, and that's going to be pretty interesting one as well. I'd like to thank all of our speakers over the next few days as well. You can see their logos up on the screen. And now I'd like to turn it over and introduce our grain market perspectives panelists. First, we have Dan Basse with AgResource. Second, Brian Burke with John Stewart and Associates. Third, Alan Brugler with Brugler Marketing and Management. And fourth, Darin Newsom with Darin Newsom Analysis. So we are going to jump right into it. And I'm going to start with Brian. You were the first to arrive into the virtual session this morning. So you're going to get the first one. First question, and everyone will have a chance for the questions as well. Audience, we are going to be taking questions, doing Q&A. You could type those into the question panel in the GoToMeeting toolbar. We're going to try and save those for the end and have 15 minutes or so at the end. You could type them in now, you could type them in later, but please use that. So Brian, first question is, how are farmers doing, and how about agribusinesses?
Well, it's a great question, and I think the answer today would be probably starkly different than if we would have had this conference in May when it was originally scheduled. There's been a significant change in price in the last 6 weeks. Obviously, if you want to paint a broad brush, you could maybe point to some producers in Iowa that were much more affected by the windstorm and drought, that there could be some exceptions. But I think from a price perspective, market opportunities, things have changed dramatically. We've seen this $1.60, 70-cent rally in 6 weeks on beans, even though we had a setback today. We've seen 55 or so cents on corn with a little setback today. So, but there's definitely more opportunities to do things. There's more opportunities to get proactive with a marketing plan even this year and next. So I would say that they're improving. I'm sure we'll get into a lot of the reasons why, but I'm thinking more along the financial side with producers. I think the situation that we're in today, more broadly speaking, could probably be defined as a bit more stressful just because of the times that we're in. But I think from a a financial opportunities perspective, producers are certainly improving from a financial perspective, and that's, you know, this fall and winter I think is going to have a lot of volatility, a lot of opportunities.
Yeah.
China's creating a lot. I'm sure we'll get into that discussion more in a minute, but it's amazing when we probably would have done if we'd have done a poll of 10 folks like the panelists that you have here back in May, and we'd have said, hey, are we going to see cash prices below $3 this fall? A majority probably would have said yes, and that has changed so quickly for various reasons. So no, definitely improving.
Darin, how about you? Any thoughts?
Yeah, I agree with Brian that the last 6 weeks have been important in these markets, and we can go back and there's I was visiting with a good friend just yesterday evening when the markets opened up, and if we go back over time, there's always roughly a 6-week period of time somewhere in the late spring through early fall timeframe when we do get some sort of weather scare. And so that's really what we've seen. We saw a weather scare that seemed to start with as Brian pointed out, with the windstorm that moved through Iowa. So we've seen a big run in corn. We've seen a big run in soybeans. Do I think it's going to last? We saw what happens today when you start to get some sell orders hitting the market, and we kind of tumbled down a bit. One day does not a trend make, but I think there are some warning signs out there that we overheated this thing. We haven't changed the long-term outlook. We just had a nice 6-week run. Hopefully, as Brian said, producers were able to use this to their advantage. It may not last that long. We may see some selling. We'll see what happens here over the next 6 weeks.
Yep. Yeah. Thank you, Alan. Curious of your thoughts.
Well, again, the farm income side is where I look at it. The USDA just recently updated their farm income data. They show that actually grain farmers are doing better than a year ago. Part of that was because of the transfer payments, the various CFAP payments, and we got another one of those announced on Friday. But the market has also improved quite a bit here over the last 6 weeks, as we've been discussing. Livestock guys, a little different situation because of the problems we have with the packing plants and backing up cattle. People were not nearly as efficient as they would have preferred to be. But again, it's a year that's rewarding those who are good managers. It's requiring you to manage a lot of different things, keep a lot of different balls in the air in terms of your crop insurance and your government payments and your actual hedging and cash sales. But overall, I think people are definitely feeling a lot better than they were 6 weeks ago.
And Dan, what are your thoughts?
Well, a little bit what Alan's saying, Mark, I actually think farm income this year will be the best since 2012. I mean, we now have $50 billion going to U.S. farmers from various government assistance. This will make up as much as 40 to 42% of their net income. Never before have we seen so much money raining from Washington. So the farmers are going to be in a very, very good shape. And if you look at the rally, USDA hasn't updated their income totals in terms of what's happened in Chicago in the last 6 weeks. When you look at that, it's really a panacea for the farmers. Now, going forward, I'm not sure if that money will keep raining in the year ahead. We don't know what the election will give us. But I want to also direct the group a little bit in saying I've got offices in Brazil and one in Switzerland. We know that farmers outside the United States are really doing well. My Brazilian clients have never seen a year like this. We're looking at 80 to 100% over variable cost returns from this year's real and where we're sitting in Chicago. So fence row to fence row will be the theme down in Brazil. Argentina's the same with the peso at a record low. The Ukrainian and Russian farmers would like to do the same should they get rain to plant their winter wheat crop or winter barley crop. So from a farmer perspective globally, this is going to be a big year, and the ones that may benefit the most are those outside the United States, even with them not getting, of course, the assistance payments that came from the U.S. government.
Now, Alan, you had mentioned a little bit about, the times we were in and impacting efficiencies, in the livestock, in the packing plants or whatnot. And do any of you have any, comments, in terms of, the times we're in
and pandemic related stuff, do you see what are you seeing in terms of that? Do you have any concerns? Do farmers have concerns outside of the processing plants? Do you see any concerns on the grain side?
I think the instability has got a lot of people's attention. Just this lack of confidence in what it's gonna look like in 6 weeks, whether that's political or trade or the coronavirus itself. Some people were kind of blaming the stock market sell-off today on the increase in coronavirus in Europe and the fact they might have to go to a shutdown. Well, obviously, when you go to shutdown, we do lose some demand or consumption. We know that from the ethanol last spring when everybody stayed home. We didn't burn the gas, we didn't use the ethanol, and that hurt the corn farm.
Yep.
But Alan, isn't that structural? I mean, aren't we losing 10% every week? Isn't USDA too high with their ethanol forecast until we get a vaccine? I mean, if I look at the work, we're 8 to 12% down every week in gasoline consumption. RFS is set relative to consumption annually. And I believe that final number in ethanol, even though USDA came to 5.1, couldn't it be 4.9 or 4.8 next year?
Definitely. It could definitely be 4.8 or 4.9. Yeah, you're right. We're running about 90% of full capacity here. The good news is we're not building any stocks. We've right-sized at the moment. We've right-sized the ethanol production with the amount of consumption the gas that we are selling. But it's a long time until next August. I think USDA could end up still being right.
Yep. Now, Darin, you spoke of prices have climbed, but you sounded a little bit cautious. Where do you stand? Where do you think we're headed in terms of price?
No idea. I mean, you get into a market like this and like what we saw overnight through Monday, I mean, the wheels can fall off immediately because usually in a spike rally like this, it comes to an end when the combines start rolling, and that's what we saw over the weekend. We saw more harvest activity here in the U.S. But I want to return to something that Dan said. He is spot on, where he pointed out that producers in Brazil and the rest of the world are doing well because of market factors, because of if we use Brazil as an example, they had record exports, they were moving soybeans, they were doing this, the real was cheap, they were making a fortune. The U.S. producers are only doing well, as Dan pointed out, because of the money coming from the administration, because of the money coming from the government. When this next election comes and nobody has to buy votes anymore, that money's not going to be there. So, how strong is agriculture really? How are farmers doing really if the only support they have, if the only thing that they can point to as being good in the market, it's the fact they're getting government money right now?
Anyone else have any thoughts on how cautious we are? Outlook?
Well, it all comes down, Mark, to China, and that may come and go. We just don't know politically what's going to happen. We believe the Chinese, at least through Sinograin and the government, have finished a lot of their reserve buying on soybeans, or at least this is a couple million metric tons from that. Will the crushers now step forward? Will they wait till cheaper Brazilian offers, to which Darin is talking about, because the Brazilians are planting? They will, of course, sell beans 50 to 70 cents. At least that's where the January, February position is today underneath the U.S. These Gulf premiums are out of sight, if you will, and today corn is more expensive to an importer than what it was back during the flooding of last May. So if you think about the push in terms of where it's coming, if it's not China, we don't have anybody else there. So I worry about domestic demand. Ethanol is mature. A feed residual to us is not a driver anymore in terms of the upside. It all comes down, will China keep buying and how much will they keep buying? And we can get lots of debates within this group or within the industry. Is it 10 million tons of corn? Is it 30? Is beans something like 28 or is it 40? That's really what will determine the markets, we believe, going forward. And I'd like to have visibility, but the Chinese aren't sharing their purchase plans with me. So somewhere along the line, we'll have to understand this with time.
Mark, this might be a good time to put up that one China export slide on soybeans.
I'd be happy to.
Yeah, this is, as Dan said, the question going forward is how much will they buy? This is an illustration of what they've bought so far. The darker blue line is this year's commitments to date. As of last Thursday, you can see that we're actually running above 2013-14 and 2014-15, which were the two best years we'd had to this point. The real question going forward is, do they get to that green line, which is the 2016-17 rate, where we ended up at 36 million tons? To my view, you can't get that high unless either one, phase one is just the driver and they're spending the money regardless of whether they need the beans, or two, the La Nina drought starts to impact Argentina and Brazil in a big way, because that ramp up that you saw on the green line in weeks 14, 15, 16, which would be December, January, was because they had some supply problems with their other chain. But we're off to a good start. They have bought quite a bit to date, and in fact, we've already got more on the books than we sold them all last year.
Now, Alan, is this a shipment chart, Alan?
This is export commitments. So this would be shipments plus outstanding sales that are on the books. So okay. Total commitments. And yeah, some of those would be at risk if they decide to play hardball. Right. I've joked to my clients, what if the Chinese come up in October and say to the president, well, we know you really want these shipped, but how about giving us Taiwan in exchange?
Yeah. Because sales are largely for show. It doesn't matter until they're loaded and they're shipped out and actually unloaded at the destination. Everyone's gotten all excited about the sales pace here early. Well, we knew there was going to be big sales because basically Brazil ran out of soybeans, or at least they got very tight, which is why their price skyrocketed. The key will be, do they actually import the soybeans now, or do they get canceled? Or as you say, are they tied to some other political event? That's when things will get interesting.
Are you guys keeping your eye on any other country in terms of exports, or, I mean, is it all about China in terms of the export market from the U.S.?
Well, that's
all about China, Mark.
Yeah, that's the irony of it. We want to call China the big, trade war enemy. But as I talk to people and as I talk to other analysts and everybody, all they want to say is, well, China's got to save this market. China's got to save that market. China's got to save all of our market. But yet they're the trade war enemy and they're supposed to save all of our markets. It's all about China.
I think I would just add I agree with virtually all statements made, but when you look at China, you look at some of the data on the rebuilding of their swine herds. You look at some of the data on the cash spread South America versus the U.S. It does feel like they need soybeans. If you just run some real quick math on 99 to 100 million tons, which that's roughly where the government has them in, that's about 8.5 million tons a month. I do think if they're going to take beans physically, October, November, December, January is almost exclusively the United States. You can probably throw in half of February. 4.5 months at 8.5 million tons per month is about 37 million tons, which is right at the top of that green line of 2016-17. So there's a big asterisk next to the sales number that I completely agree with the other panelists that we need to see them ship. But the cash markets, spreads, basis between South America and the United States are at least all pointing to that demand being real. So not to throw all the cold water on this just being some dressing up of phase one in front of the election, and everything changes after that depending on what happens. Of course, we're all worried about that volatility, but there does seem to be some real demand there too.
Mark, if you could throw the other soybean export slide up there. Yeah, that one. This is that's the total export commitments year to date, include all the rollover that we had before September 1, and but this is to all destinations. And over the last couple of years, China has been, excluding the trade war meltdown, they've been approximately 63 to 67% of all the unloads in the world for soybeans. So they are the market. One thing that we found out during the trade war, of course, was that there is substitution. If they're not buying other countries, if they're buying all Brazil, other countries have to buy from us. So you do get some shifting around. My concern here is that they're going to crowd out some of the other buyers.
Take a look at your 2019-20 line, Alan. I mean, we didn't move anything until the very end when it was China again. So I don't see it as a zero-sum game. I don't think just because China's buying exclusively from Brazil and shipping from Brazil, that means everyone else is going to come to the U.S.'s door. That just isn't how it played out last year.
Yep.
Well, wait, gentlemen. But what happened last year is China not bought 16 million metric tons additional. That was the big kicker in terms of their total demand, which is why they're up at 98 million metric tons in the old crop year when they started out down with an upper 8. And now we're looking for 1 million metric tons of additionality in this crop year, which may be a little bit low. We believe that China will take 99 or 102 million metric tons of beans. It's just that they're taking them from now and then they'll pivot and take them from Latin America. And what we'll get is more volatility in basis on FOB levels and another thing in global markets as they shift their demand back and forth. But to Brian's point, I do think China's repopulation of their hog herd does give us more of an appetite for China to buy U.S. beans going forward. But the big question is this: will they keep that 16 million metric ton growth rate, which they did from Brazil from really March up until now? Will they keep that going? And is it because of their hog herd? We don't know today, but I think that's the big question for the bean market. And really, are we having a new demand driver entering agriculture?
So, related question I had come across, how much reserve stocks have been used up in China since January? And do you think that is why they are buying up soybeans from around the world?
Usually we get that reserve question relative to corn because they have, according to USDA at least, fairly substantial corn reserves. And I'm going to stay on the corn subject here for a minute. The fact is they've got two types of reserves. They've got the strategic reserves, which are essentially military stocks and so forth that are not public and nobody really knows what the number is. Then you've got the reserves that they buy from the farmer in the fall as a price support mechanism, usually from October through March, and then they sell them back to the market in the second half. Those stocks were almost zero at the end of August. That's the more readily publicly available stocks. So from that standpoint, the Chinese stocks look very tight, and you saw that with the Dalian futures going to record highs here recently. That's pretty tight. On the soybean side, they've never really had that much of a stockpile because they are comfortable trading or playing off South America versus the U.S. As long as they've got both of us to play with, they don't need to maintain a lot of inventory at home.
Dan, I want to go back. I want to go back to something you said, Dan, where you mentioned this might be a new demand market in soybeans. Does it look like that to you, or does this at this time look more like just a normal short supply scare, which we get every once in a while with the with the spike rally and the move to inverted future spreads and basis still holding together relatively well? Right now it screams more of a short supply scare that don't usually last all that long, as I said, until about the time the next combine starts to roll. Or do you actually see that this is turning into, or I guess you probably phrase that there's a possibility of it turning into a new demand market?
Yeah, Darin, we don't know yet. If I look back, it was that combination of a late summer unusual drought, along with China, as I said earlier. They took 16 million metric tons more from the world in that period from when the Brazilian harvest started in February up to where they are now. Will that additionality, if you will, continue? And is it because of their rebuilding of the hog herd? I don't know today, but I think all of us on this panel would be well served watching that. And we can measure that through COFEED's annual or weekly crush number from China on soybeans. Again, you got to bring in beans and then you got to crush them to make products. Those will be the kind of ingredients we can look at in terms of deciding. my answer to you today is I really don't know. I'm watching, but we'll all kind of figure it out as we go down the road.
And I like that answer, Dan. I respect that answer.
So do you gentlemen, would you, I mean, sum up your, your price outlook and basically issue, you're cautious and things are likely to be more volatile? Is that your shorter term?
I think so, Mark. I mean, with what we've done, I mean, I look at domestic soybean basis levels, and I look at this from a farmer's perspective. I mean, it's very hard for him not to look at this as an opportunity today. I could view basis risk as a 50-cent risk between here and the end of the year, just based on the transition into South America. So as I look at cash prices, more so compared to historical values, maybe more so than futures prices, I think it's a cash price that needs to be protected, and he really needs to participate. Barring a La Nina related South American drought, which that's something we talk about every year, but it only happens maybe 1 in 7 in Brazil and 1 in 15 in the US, but that's always a risk. I'm a much bigger proponent of giving the market the cash grain that it needs and wants right now. It is screaming for soybeans. That's usually the best time to sell it. And if you want to participate in some sort of a what if upshot, I'd rather do that on paper, because at least I take the basis risk off the table.
I agree completely with Brian. And if we look at the commodity national soybean price index, it's moved up into the upper 10% of its price distribution rate based on weekly closes, going back through 2014. This is a great opportunity. Brian's exactly right. This is, if the market's saying sell, you're going to want to sell, and the cash market that high, it's just an ample opportunity to get some sold.
Great.
Well, I think we're all singing in the same chorus here. Listen, I tell everybody, to me, it's soybeans are the question. We talked about that already. Corn is the one uncertainty we have because it's so political into China. To get corn into China, you need a GMO certificate. And so the Chinese government controls everything that comes in and out relative to corn. It's not done, but at the highest levels of government. Let's say, for instance, the Chinese do need to import 30 million metric tons of corn annually. Well, that would be about 1.1 billion bushels. And if I work that backwards, that's about somewhere in the vicinity of 6.1 million acres. In Mato Grosso, Brazil, they only planted last year 43% of their soybean crop back to safrinha corn. So I probably, in Brazil, with prices of corn where they're at today, can bring in 3 of that 6 million acres just back in Mato Grosso. And then we've got the additional prevent plant, which was 10 million acres this year, probably should be 3 to 3.5. So if I bring back the U.S., I still don't have the components for a lasting structural bull market, but it's fun while it lasts.
Nice.
Yeah, no argument here on that. Corn's, and it's evident, corn has been a reluctant follower. The relationship corn to soybeans is certainly in favor of soybeans when you look at the historical averages there as well. So it's a more challenging commodity for sure to get a little bit more long-term structural bullish, especially Alan pointed out the ethanol backdrop, second wave coronavirus this winter. I mean, all of those things are risks that I think are keeping corn from participating at the level that soybeans have. It just makes sense to be more cautious on corn.
Mark, if we could pull back the beans for just a minute and pull that third slide up. This is a little complicated, but basically what we've done here is we've got the USDA's WASDE forecast. Those are the white columns for last year and this year. The red numbers are the ones that were changed in the September WASDE report. The gold colored numbers going left and right from USDA are variant scenarios. And then we've got some prices down below that in the yellow, which are based on historical performance since 1980. And what we've done is index these around the cash average prices that USDA puts out. So if I could draw your attention to the middle white column, which is WASDE's numbers from September, you'll see that they had a 925 cash average price. Historically, in years with above 10% stocks usage ratio, that would imply a futures trading range, average range, not all years are average, of 847 to 1057. If we can get it below 10%, that range expands. In other words, large stocks do tend to dampen the range a little bit. If you go to the second column from the right, which is our best fit estimate for today, you'll notice that we are using a lower yield. We're using 50.1 bushels instead of USDA's 50.9. That's, to me, one of the key questions coming up here. The market's definitely trading a lower yield than USDA gave us in September because we didn't have the freeze damage in the Dakotas factored in. USDA said that. They said they're going to resurvey, or they're going to factor that in. They're also going to resurvey Iowa again to see if there's more abandonment. That's probably more on the corn side. But the point is, if you drop that yield to 50.1, your expected range for the year in the 10% stocks would be 862 to 1072, and we're done. All right, we've done that. If it gets below 10, goes down towards 9% or 8.5 because the yield's a little lower, and of course we're assuming that the stocks or the exports hold up here, then you could go as high as 11.25 over the next 12 months, just based on average behavior of the market. But I think this gives you a little perspective as to what the potential outcomes are. You're either done or you've got potentially up to 50 cents more, but you need that lower yield and you need the exports to hold together to do it.
Thank you,
So Alan, let me challenge you. Let me challenge you a little bit. What if your export number was 2250 to 2450, which is what a lot of commercials are using, and you then end up with soybean stocks with a 1 in front of it instead of a 3?
Then that's going to take your cash average over 10, and that'll take your potential high futures over 12 for sure. That's a curve function. I can't do it in my head, but again, yeah. But I would argue that the price rationing would start to kick in there. You'd start to see your crush drop off a little bit. But yeah, that's where it gets really exciting. And to your point, Dan, well, that would tell your Brazilian friends to plant double fence row to fence row.
It'll also get exciting, to use your word, Alan, if we see exports drop to that 1.6 to 1.7 again. That would make things exciting as well.
Only if you're short.
Well, what do you guys think that China's bought already? I've got them down somewhere around 24. Where are you guys? Because maybe I'm all off here, but we're at 24 on our way to 32 to 34. It's kind of hard to have an export number less than 2.2 billion.
I'm kind of in that camp as well, Dan. 22 to 24 year to date. That depends on how much of the unknown you want to give to China. We're using just an historical number, but maybe it's higher than historical, for the unknown category. But yep. I look at it as Brazil in 2019-20 was drained substantially of their soybean stocks due to the US-China trade war. You've got that transition for them in December, January to get through, which is extremely tight. And when they do start their harvest, it's going to take a while to get that domestic pipeline filled before we see substantial exports out of Brazil. So I might even be just slightly higher on your Chinese export number, maybe closer to the 36, 37 that we saw in 2016, 17, whatever that number was. But it's you hit the nail on the head when I was looking at Alan's numbers there. I said, well, this looks different with the 2.25. You took the number right out of my mouth, and that's kind of where we are for bean exports.
I'm lowballing it for political risk.
Fair enough. that risk is there.
All right.
But I will go back to something Dan said too. I mean, am I in the camp that this is a demand-driven rally that has multiple years worth of price effect? No, I'm much more in the supply side that Darin mentioned.
Yep. I agree with you, Brian.
All right. So in terms of wild cards, impacting grain markets, it's the pandemic, of course, it's election, China, Brazilian crop, a little bit. Anything else you want to add to that list? And what's your ranking order?
I think we also have to watch the dollar. I know we had Fed Chairman Powell come out last week and say, it's going to be years before there's a raise in interest rates, which, usually kicks the wheels out from under the dollar. But we're seeing support in the dollar. And I think it has to do more, again, with global investors are looking for something. We saw gold and silver take a beating today. We saw the European banks get hit hard. We saw the euro down. So money might start flowing into the dollar despite the fact that we have no interest rates. And if that's the case, then all of a sudden these caveats that were built into this mythological phase one deal start to fall apart again. And once Brazil rebuilds its supplies, all of a sudden the market does not favor the United States. And once the market does not favor the United States, China is not necessarily bound to buy from us. So we have to watch the dollar. I think we have to watch the dollar closely, and the real isn't going anywhere. It's still trolling along near its weakest point. So I think we have to watch the currencies. I think it's going to be a key. I think it's going to be key over this next year.
I agree.
I think that's right, Darin. I would also add there's a lot of dryness right now in the Black Sea, and there's people defaulting on contracts of both corn and other things. So we need to get the Russians and Ukrainians, Romanians, Bulgarians planting their winter wheat crops. We need to get the winter barley crop in. I see Gask is back tendering for wheat again this afternoon. We need to have that happen. If that goes along without a problem in South America, all this can relax. But I just feel a little anxious until we get some of those weather abnormalities resolved.
Agreed.
Yeah, I would just you mentioned one thing that I use in my stump speeches. You have a small town with a couple of retail stores, and then Walmart comes in. All of a sudden, you have surplus capacity, and usually what happens in that situation is somebody gets crowded out of business. Ag is a little different because you can have that surplus capacity, and in 6 months, Mother Nature can fix the problem for everybody, basically by reducing everybody's inventory. So, to me, that's still the number one wild card that's out there. Yes, there's trade issues, there's the currency issues, there's the pandemic and so forth. But ultimately, the weather is we're carrying plenty of inventory of corn, soybeans, and wheat right now globally. But that's something that can change in a fairly short amount of time.
Question on the screen mentioned Russia now. So do you see Russia starting to play a greater role in soybeans over the next few years? Gentleman made a comment about an article that thanks to global warming, it may be feasible to plant soy in the Russian northern Arctic or the Arctic.
I don't know about my colleagues. I tend to go to Russia once or twice a year and visit clients. I will tell you, I've never seen so much corn planted south of Moscow than I see now. It's becoming a big corn area. They like the yields. They're understanding the crop. Soybeans less so, though they are building some crush facilities at port and starting to look at avenues there. But I do think the Russians, which, 25 or 30 years ago was the world's largest grain importer, will be significant in terms of an agricultural producer in the years ahead. And I say that not only for grains, but also for livestock. So if the currency is right, the margin is there, the Russians will do it. And increasingly, the government's getting involved to make sure that happens. So I believe that their presence, whether it be in wheat or corn or soybeans, will be growing with time.
And I would just add infrastructure investment to the list that you just said. So whether that be South American infrastructure, Black Sea infrastructure, it seems like there's a tremendous amount of emphasis there as well. That when you look at it is partly the low cost producer, but that's only part of the equation. And the efficiencies in which these other regions are getting to the market and to the market demand centers is pretty impressive. Railroads, port facilities, Amazon barges, all of the above. It's substantial. The logistical advantages that are shifting around the world to where the United States is is a origin amongst four, as opposed to one of the key origins. And that shifts between which commodity we're talking about, of course, but truly a global marketplace.
Well said, Brian.
Yeah, another
and
audience question. Same goes for Argentina. Any comments on their production?
Mark, today wheat, corn, and soybeans will keep rising with the peso. There's a little bit of government uncertainty down there relative to inflation and a rather socialistic regime. But other than that, I do believe that Argentina holds big potential. And really, to Brian's point, we used to talk in this industry about no cure for low prices like low prices. Well, unfortunately, the world in a global market, not everybody is low. The Russian farmer, the Argentinian farmer, the Brazilian farmer, even if we had corn under $3, we didn't lose that 5 million acres in June. We had normal weather through the end of summer. I have no doubt we'd be at $3 or under today, but those farmers would keep it going. And when we think about the other side of that, which is rationing demand, we now only have to ration demand every 6 months because it's a hemispheric thing. We've got a big supplier on the other side. So we only have to make it for the end user side to the next harvest, which oftentimes is, like I said, 6 months away. So a much, much different environment in terms of the agricultural markets than where this would have been 20 or 30 years ago.
All right, I'm going to switch gears here, guys, a little bit, and we'll come back to a few more questions that are popping up on the screen here from our audience. Last question before we go into Q&A I have is a little bit different, and it's, when it comes to the technology changes in agriculture and the grain markets, where do you see the most benefit coming from, whether it's in production or yields or profitability, when you compare, say, and the outside with farming and machinery and the inputs versus the inside or in the office with data and analytics and these ag tech firms that have been popping up all over the place. Where do you see the greatest impact coming from in terms of yield, profitability, production, or anything else? Any comments?
I think the one thing that strikes me is simply more yield. All right, all of the factors that you mentioned tell me we go to more efficient production. Whether it's you're placing your seeds closer and fine tuning your irrigation, or if it's establishing some of the curve things you've done with basis, so that you know what the optimal basis is for that location at a certain time of the year. There's a lot of arguments on both sides for more efficiency, but of course that additional production creates its own issues as well.
Yeah, a lot of the farmers that I've talked to, they point to their ability now to all of these different practices that are there, all of the not necessarily technology, but just different things that we're doing, allowing for better production, more consistent production. I mean, even this year, the early yield results that we're hearing, despite some of the weather problems and some of the driest areas, are still running well above expectations. So, I mean, is this the science behind it all? Is there different production? So I'm going to go back that the most important thing that we've seen is a more consistent, is ability to produce more consistently. And that, as Alan just said, has increased, has continued to bump up the yield. So they go hand in hand. But I'm going to say it's all of the new technology. It's the new ways that we have of improving our production so that we do see a more consistent product, more consistent yield.
Yeah.
Great.
If I could jump back.
Go ahead, Alan. You're fine.
Okay, just one more thing. To go to the derecho situation that we had in Iowa in August, I was very impressed with what some of the firms were able to do with big data to refine that yield estimate, that acreage impact, using infrared signatures and radar backscatter and things of this nature to fine tune how much damage was done to which counties. And we could not have done that 10 years ago. We'd have been just waiting on the USDA Farmer Survey to say what happened to you. so there's a lot of advantage or a lot of impact of these big data tools that everybody's trying to develop. And I think that's an early example of how valuable it can be.
Brian?
Yeah, I would just add to the previous comments, but it's one of the things that makes me a bit nervous. When you look at the United States and you look at the technologies that we're deploying today, you look at the agronomics that we're putting on these fields, all the cover crop rotational things. And I'm not an expert in that area, so I don't want to pretend to be one. But when you look at the spread between the United States yield and many other areas around the world, in corn in particular, and less so in soybeans when we're comparing to Brazil, a lot of these practices are going to get deployed throughout the world. And you look at our 2.2, 2.3 bushel per acre trend line type of yields, with what we're seeing and what we're learning, I would venture to say the yield curve in other countries could probably be steeper than in the United States. And that's a technology transfer that can be a two-edged sword.
Which makes Dan's point that much more interesting about the increased acres in Russia. And now we add Brian's thoughts in about this, exploding yield curve. It's going to get interesting.
So to me, gentlemen, if you were to ask me what my biggest technological gain was in the last decade, I always refer kind of the same thing, which is really pretty simple, and I'm not sure it's technology even, which is the planting of winter corn in Brazil. I mean, if we go back to 2012, when Brazil was hardly even a corn exporter or producer, and in 6 years, they've become the world's largest corn exporter in their own local market a year. I mean, I marvel at that. And so if we think about Brazil going forward and what their capabilities are to produce corn, it's demonstrative now with that northern arc of logistics that are there. So I think that's a huge technological change. Again, I'm not sure who I can credit it to other than the market in the drought in 2012, but the Brazilians have really gotten corn right.
Last thing I'll add, and this probably falls in the category of not a technology either, but I think when I talk to groups of producers, and I'm sure we're all in the same camp, it has made a 24 to 36 month marketing plan that much more important, because those opportunities just don't present themselves. And a lot of the market participants that are out here trying to add exposure or products or different things out there that take advantage of those opportunities when they come is again, I don't think I'd put it in the technology category as much as I would just an emphasis of a successful producer and some of the things that he needs to be looking at. And that's a much wider window for his marketing plan to get executed, because the opportunities kind of come and go quickly.
Great, guys. Some really good answers there. A few questions on the screen. So how about the freight market? What do you see in there? What role do you see it playing in valuations? Any outlook or commentary on freight?
If you're talking international freight, there's a lot of drivers there that are more significant than agriculture, such as the iron ore and obviously your container ships and so forth. If you're talking more domestic, this year's not going to be one. It's going to be an anomaly type of year due to the lot closures on the Illinois River and the timing that's changing some of our barge freight structures. Capacity constraints out of the Gulf, out of the PNW, have been well documented in the last couple of weeks about what is this fall and winter going to be from a capacity constraint standpoint. And I think all of those things are valid. I'm not saying any of those are necessarily wrong. I think that's what's feeding the market more of that bullish fodder that has caused the last 6 weeks to happen. So yes, we've had a spike in freight of many types, truck, barge, rail throughout, but it's likely temporary domestically in the United States.
I agree with Brian, and really what we need is investment down at the Gulf. I mean, we just don't have enough capacity to keep up with the others. So if you think about the Northern Arc in Brazil can now pump out 110, 120 million bushels of beans a week. They're doing better down there than we are. So I believe even though ADM's got an elevator down, we need more investment in the Gulf or other export points to keep up with the rest of the world, which I thought in my career I'd never say.
What was the peak this spring out of Brazil for beans? I think it was about 14 million tons in a month for soybeans. I don't know if it was April or May, but has that happened here in the United States? It has not. I mean, we're going to be feeling like our hair's on fire at about 8 to 9 for soybeans. So let's that just echoes your point, Dan.
Yep.
Another question here. Attendee asked, I had a question regarding the WASDE report. Given the technology, do you see WASDE report becoming less and less relevant? And a nice shout out here for Barchart. They said, for instance, Barchart provides daily grain yield estimates on a daily basis.
Well, from my point of view, it can't get less relevant because I think they're completely irrelevant to begin with. But I do think that we're seeing that in the market as well. That, you know, it was mentioned before about how the technology for, you know, yield forecasting when the derecho moved through, you know, it was immediate. Well, USDA is never going to be able to do that. So I think it is becoming less relevant. I think we are seeing more focus on the private side of this, the private technology that's out there, the private tools that are out there. I think that's the way that we're going. I think that's the route that we're going to be going down.
Thanks, Darin.
The only difference, gentlemen, is USDA uses a complete different methodology of survey, which is one plot every square mile across the Midwest. So unfortunately, the satellites and their methodology will never square up. So it's all a question of who you believe each month.
Mm-hmm.
And at the end of the day, what's the money watching? But
Yeah.
And
I don't think
there's a disconnect that's growing, Darin, and I completely agree that this private data, private surveys, private technologies, I think the growth in that is going to continue without a question. And so the disparity between the USDA information and some of this private data is going to get wider and wider. But we still don't see up limit, down limit days on a number that's not USDA today. So and it's really just how do you square those two? And over time, it's going to be interesting.
Oh, you know, and I get that. But what we really see, you know, is these private investment firms, these global investment firms are looking for real data, and they don't get that from USDA. Now, okay, yes, we have volatility. It usually comes and goes in a matter of about 5-10 minutes, and then we're back to reality. And that reality is being fed to these investment firms every day, up to the minute updates. And again, that's not USDA. That's the private analytical firms that are providing this.
But Darin, you still got to have a measuring stick, whether those are right or wrong.
I disagree.
And unfortunately,
what good is a wrong measuring stick? It's no good whatsoever.
The problem I have is I may get 5 or 6 different satellite surveys, and which one do I believe what day and what year? And so that's a little bit of the problem until we get ground truth to prove one right or wrong.
The thing is, there is no right or wrong. I mean, we can build a general idea. There is no knowing the actual numbers, and it's you know, irrelevant to try to guess that there is. But what we can get is, you know, okay, so what fits best with what's the forward curve telling us? What's basis telling us? What's the underlying cash price? You know, like the commodity national indexes. What are they telling us? And then which firm is providing the information that best fits what the market's actually trying to say? That's really the only measuring stick I need.
Great.
Now, if Chicago would only follow the cash markets, we'd all have it right.
In the end, they do.
Yeah.
If the audience has any questions, please feel free to type it in. I'm gonna just throw one more out there if anyone, the panelists, want to answer on the election. You know, whether it goes right or left. You know, what impact do you see on the grain markets if it goes one way or another?
I will start with a huge asterisk of its politics, and we shouldn't have that question on this panel, but I'll start. I think what the market's got baked in a little bit, because it's been a common comment that's come out, is that our relationship with China, as important as it is, with a Trump reelection, in all likelihood, gets worse, agriculturally speaking. You're thinking about it from an agricultural side, tariffs, trade imbalances, and so forth. And again, I'm trying to stay focused just on the agricultural side, not the stock market or anything like that. So when we think about agriculture, it's that Trump reelection gets a bit contentious with China, and there are other factors in play. There could be energy policies in play that go one way or the other, but I think China being one of the still key indicators to world agriculture, it's hard to get real bullish U.S. agriculture with maybe another confrontational 4 years.
Maybe said better with Brian, a decoupling of economic prowesses between the United States and China. And then we never bring up the question that really needs to be asked is, when do farmers start getting paid for carbon sequestration and the benefit that they provide in climate change and all of that? But, that's another whole hour we could spend talking about a developing market.
Yeah, it's interesting. Yeah.
Yep, great point.
Yeah, I don't see the election changing. The U.S. is now a secondary provider to China. Weather will decide whether or not that it improves all that much. Basically, the biggest thing that I see post November is the federal funds get shut off because nobody, as I said earlier, nobody has to buy votes anymore, and so that money stream gets shut down. So that, to me, will be the biggest thing coming out of this election.
I'm keeping quiet.
The smartest one of the bunch right there.
Well, now, we've had this discussion with a number of my clients, but the problem is that you have stated party platforms and you have actual implementation. Number one, we don't know who's going to win. Number two, as has been argued by one side, there's a Trojan horse issue of the guy you're electing might not do what you think he's going to do. And I think that you hear that on the other side as well, that, okay, in a second administration, they might not do the same things they did in the first one. So I think you have to recognize that, as Don Rumsfeld said, you have known unknowns and unknown unknowns, and this is definitely an unknown unknown.
Any final comments or questions for one another?
Let's do this in person next year.
Yeah,
Yeah,
that'd be nice.
That would be nice.
I want to say thank you. I think that was very entertaining. Some interesting thoughts, some new ideas there. I've got some notes, hopefully for some follow-up. We could do something again off of some of these other topics that may be a little bit different as well. A big thank you to all four of you for participating. Thank you very much.
Thanks for the opportunity,
You're
Mark.
welcome, Mark.
And to our audience,
thank you, Mark.
thank you everyone. We had a great turnout. Really appreciate you connecting in. Tomorrow we'll have the ethanol panel kicking off same time, 2 p.m. Central. Hope you can make it. And then Wednesday for our third panel at 2 o'clock as well. Thank you. Bye-bye.